Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page. At patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. Okay, welcome back. In this video, we're going to talk about selling or being naked short puts this time. In the last video, we talked about calls. This time, we're going to talk about puts. Now, this is one of my favorite strategies, okay? And you will see why. So, the opinion is neutral to bearish, okay? And you will always receive a credit for this. So, refers to selling a put without owning the underlying stock, which will give you limited risk, which would be the full amount of the stock price minus the premium you collected for selling the put, as the stock can only fall to zero. You will want to sell a put if you think the stock will go sideways or higher. So this is a bullish trade, right? You also can sell a put if you want to own a stock at a lower price and bring your cost basis down if the stock is put to you. So here's an example. We would put an order in to sell one XYZ October 20 put, okay? And we would collect a $1 premium for this. So our max loss would be $19, right? Because the stock could go all the way to zero. So so we're kind of capped at how much we could lose. The max profit would be $1. And the break even is if the stock closes at $19, right? So remember, we want the stock to go higher. So as long as it goes higher, that put will expire worthless. Just like with the call in the previous video, when we sell a call, we want that put to actually expire, or that call to expire worthless by price going down. Well, this, we're just flipping everything upside down the other way. So here's an example. Stock XYZ is trading at $20, and you think in the next month the stock will trade sideways or above $20. So you can sell a $20 put and collect $1 of premium. And as long as the stock stays above the $20 price by expiration, you will collect the full $1 of premium, and the option will expire worthless. Your break even on this trade is $19 and will start to lose money if the stock trades below $19 at expiration. Now let's pull up a chart, okay, going back to the Viacom. So let's say we sell this 40 put. Right now we're at 41.71, right? So let's say we sell this 40 put and we collect $1.93. Well, we know that we could be wrong essentially by $1.93 to the upside, right? Before we actually start losing money. But if it does, on the downside, because that's our break even. So 40 minus $1.93 would be about what, 38.07, somewhere around there, right? Is our break even on this if we're to do this trade. But here's what I really like about this trade is I know I could sell that 40. Let's say I really like Viacom, and I'm actually bullish on it, but I go, hey, I want to buy 100 shares at 38 we'll say. Okay, well, I could go over and I could put an order in to buy 100 shares of Viacom. I could come up here, put a limit order, okay, to buy at $38. And I could do good till cancel. Well, over the next 28 days, if price never trades down below, let's say it just keeps going up and up, did I ever get filled on this? Nope. I never actually got filled on this order because it never triggered. Price never got down there. So I'm going to miss the trade. But if I sold this 40 put and I collected $193, well, guess what? I got paid while I waited for the stock to pull back, which it never did. So instead of making nothing, I ended up making $193 on that trade. So that is selling puts. It's probably, like I said, my number one strategy. I think this is what the professionals do because you're able to be dead wrong and still make money, right? So think about it. If I could be dead wrong by $3, almost $4 and still make money, I'm okay with that, right? Because it's one of those things where we don't know where it's going. We have our assumptions, but if I could be dead wrong and still make money, I'll take that trade all day long. Now, the one last thing is where we lose money is, let's say we trade down to $35 at expiration, right? The stock reverses, goes back, right? And we're now at $35. Well, we know 38.07 was our break even, okay, on this trade. Well, if we're at 35, we've now lost $3.07 because we were obligated to buy 100 shares at 30, essentially a 40. We collected our premium of 193, but the stock is $5 below this level right here, right? So at 35, so that's where our loss would come in. But I'm okay with it because I was going to buy that stock at 38 anyways. And what happens is once you get put the stock, you could then turn around and sell a covered call against it. So I hope that helps explain. Really try and figure out or understand selling puts is the number one strategy. But that's it for this video. We'll see you on the next one.